Welcome back to Talk Tickers. It is Wednesday, January 21st, 2026. If you are tuning in, you want the signal, not the noise. You want to know what is actually moving the money. And today, we are cutting through the static to look at a regional bank that is, well, putting on a clinic in financial discipline.
It's a fascinating morning for it, too. We're looking at People's Bancorp, ticker PEBO. And, looking at the market reaction, it really feels like investors are finally starting to appreciate the art of being boring.
Boring is the new brave. I feel like that should be on a t-shirt this earnings season. The stock closed up 1.15% today, trading around 31.57. It actually had a bit more of a pop in the pre-market.
Yeah, it got over 32 for a minute there, but it settled into what I'd call a cautiously bullish kind of groove.
Cautiously bullish is perfect. And to set the stage here, this wasn't a quarter where they shot the lights out with massive growth.
No, not at all. If you tuned in hoping for some, AI-powered banking revolution, you're in the wrong place. But if you're looking for a masterclass in balance sheet mechanics and what the CEO calls strategic patience, then this is the deep dive for you.
I love that phrase, strategic patience. But before we get into the high-level strategy, let's just unpack the headline numbers. What exactly did PEBO deliver?
So let's start with the bottom line. They delivered. GAAP EPS came in at 89 cents.
Okay, and consensus was what, 88?
88 cents, so a penny beat.
Just a penny.
A penny beat, but you have to remember, context matters. In this environment, with rates doing what they're doing, a beat is a beat. It proves they can manage the bottom of the ledger.
Okay, but the top line, the revenue, that was a little softer, wasn't it?
It was, yeah. Revenue came in at 117.32 million, which was a slight miss against the 117.98 consensus.
So let's pause right there. Usually if you miss on revenue, the algos just punish you instantly. Why did the market just shrug this off?
Because the market, at least today, was smart enough to look under the hood. That bottom line beat wasn't luck. It wasn't some one-time tax thing. It was discipline. They are pulling the right levers on costs and credit quality instead of chasing risky growth.
And the key metric here has to be the efficiency ratio, right?
Oh, absolutely. We need to spend a moment on this.
Yeah, so for everyone listening, that's basically the cost to generate $1 of revenue. Lower is better.
Exactly. And PEBO held steady at 57.8%. I mean, in a world where compliance costs are spiraling and tech costs are eating margins, keeping that lid on tight, sub 58%, that is impressive.
It tells the street that management has their hands on the wheel.
That's a great way to put it. Okay, so we've established they run a tight ship. I want to get into the gears of how they're doing it. Let's start with something that sounds incredibly dry, but is actually kind of genius. We're calling it the micro-optimization of the balance sheet.
Right, the plumbing. This is about some debt they inherited, isn't it?
Yeah, from the Limestone acquisition. When they bought Limestone, they got this chunk of subordinated debt.
Okay, so that's junior debt. Higher risk for the debt holder, which means a much higher interest rate for the bank.
Precisely. And this specific debt was carrying an 8.5% rate.
8.5%. Wow.
I mean, think about that. In banking, your cost of goods sold is the interest you pay. Paying 8.5% on your funding is like lighting money on fire. So they wiped it out.
Paid it off. But they still need liquidity. So what did they replace it with?
Much cheaper funding. FHLB advances and brokered CDs. Basically, they swapped expensive bespoke debt for commodity-priced funding.
And what does that actually mean for the bottom line? Is this material?
Oh, it's very material. They're projecting about $1 million in annual savings from just this one move. And the earn-back period on the transaction cost is less than 1 year.
Less than a year. You take that ROI every single day of the week.
Every time. It's unsexy engineering. It's not a new app, but in this environment, saving $1 million a year just by swapping out the pipes, that's highly effective.
I love that. Okay, moving on to theme 2. We have to talk about the North Star. And no, we're not talking about navigation here.
Right, North Star Leasing. This has been the pebble in their shoe for a little while. It's their small ticket leasing division.
And it's been a source of, let's say, credit friction.
Friction is a polite word for it. Leasing charge-offs contributed 31 basis points to the annualized net charge-off rate.
Whoa, 31 basis points from just one division. That is a heavy drag.
It is. I mean, you strip that out, the rest of the bank is running incredibly clean. It's the specific high-yield, high-risk leasing book that's hurting them.
So what's management doing? Just hoping it gets better?
No, and this goes back to that discipline theme. They are aggressively shrinking this book. A year ago, they had about 35 million in high balance leases in this division. Today,
What is it now?
it's down to 13 million. They're just bleeding it off.
That's a huge reduction.
Yeah.
And they're guiding for this to improve.
They are. The guidance suggests charge-offs are going to plateau here for a bit, maybe stay elevated for another quarter, but then start easing in the second half of 2026.
Now, I have to bring this up because it was a great moment on the call. The big juice moment.
Yes, the big juice.
The CFO, Katie Bailey, she joked that this high-rate leasing provides big juice to the margin.
And the CEO immediately jumped in to confirm that big juice is, in fact, a technical banking term.
I'm going to start using that. But jokes aside, it highlights a real tension, right? That division provides high yields,
Yeah.
the juice, but it comes with the squeeze of higher charge-offs.
Exactly. And right now, the squeeze is a little too tight. The market is watching to see if they can keep the juice while reducing the squeeze.
Okay, let's pivot to theme 3. And honestly, this is where it gets really interesting for me, the strategic constraint. We need to talk about the $10 billion ceiling.
This is the single most important strategic signal from the entire call. We need to explain why 10 billion is such a magic number.
Please do. Why is it the line in the sand?
It's the Durbin Amendment. In the U.S., once a bank crosses 10 billion in assets, a regulatory switch flips. The government steps in and caps the fees you can charge on debit card swipes.
So your interchange income just gets crushed.
It gets crushed. Plus, you get more scrutiny from the CFPB, higher compliance costs. It is expensive to be $10.1 billion. You want to be 12 or 15 billion so you have enough scale to absorb those lost fees.
And the CEO, Tyler Wilcox, he was incredibly explicit about this.
He was. He stated flat out that they have no plans to cross the $10 billion threshold organically.
But if they did nothing, just let the bank run, they'd cross it in 2027.
Exactly. They're on a collision course with this regulatory wall. So he said they'll pull levers to stop the growth. They'll let the investment portfolio run off. They will actively choose not to grow just to stay under that line.
This is fascinating. They're putting a governor on their own engine. But you can't stay at 9.9 billion forever, can you? Shareholders expect growth eventually.
No, and that's the real implication. If you refuse to cross 10 billion organically, there's only one path left.
M&A.
Precisely. This signals that an acquisition is the only intended path to becoming a larger bank. They aren't going to inch over the line. They want to leap over it with a deal large enough to absorb the hit.
Which puts a huge spotlight on their M&A strategy.
Ugh.
Okay, but first, theme 4, the 2026 guidance. We're looking at a falling rate environment. How is PEBO positioned?
So their net interest margin, their NIM, the outlook is guided to 4.0 to 4.2%.
That's a pretty healthy M. A 4 handle is solid for a regional.
It's very healthy. But, and this is a big but, that guidance assumes only one 25 basis point rate cut for the entire year.
Just one. The market is pricing in way more than that. What happens if the Fed cuts 3 or 4 times?
Management quantified that for us. They said each additional 25 basis point cut creates a 3 to 4 basis point headwind to their all-M.
Okay, so let's do the math. If the Fed cuts 4 times, that's 3 more than their model. That knocks, what, 10 to 12 basis points off their margin?
That's right. Suddenly that 4% floor starts looking like 3.88. It's a material hit.
But they're also targeting positive operating leverage.
Which means they plan to grow revenue faster than expenses no matter what. And it all ties back to their loan growth guidance. A really conservative 3 to 5%.
That does feel low.
It is. But remember the CEO's quote, "We would rather deliver lower loan growth than unfavorable metrics." They are not going to chase bad loans to hit a target.
Okay, so bringing this all together, we know they have the $10 billion cap. We know they're looking for M&A. What does that landscape look like?
They were very specific, looking for deals in the $3 to $5 billion range. Geographically, it's Ohio, Kentucky, West Virginia, Virginia, and the adjacent states.
It's a wide net, but it's contiguous.
It is, but the key phrase the CEO used was strategic patience. They're waiting. But, that refusal to grow organically puts this hidden timer on their strategy. You can only tread water for so long.
Right. So why should a generalist investor care about PEBO right now?
Because PEBO is the perfect proxy for the disciplined regional bank. We're seeing this divergence in the market. Some banks are betting falling rates will ignite loan demand and they can ignore margin compression. PEBO is saying, we're going to protect our margin and our credit quality at all costs.
It's the difference between betting on a boom and preparing for a grind.
And PEBO is dressed for the grind.
All right, we have unpacked the earnings, the big juice, the strategic constraints. Now it is time to shift gears completely. We are entering the not financial advice zone.
My favorite part.
The disclaimer. We are not your financial advisors. Do your own diligence. But if you are a hedge fund analyst pitching a wild idea right now, what's the trade?
Okay, picture the scene. I've got one slide on the screen. The title is The $9.9 billion Pressure Cooker ARB.
I'm intrigued. Lay it out.
The logic is this. Management has explicitly said they will suppress their own growth. They have created a coiled spring. They have backed themselves into a corner where M&A is the only escape hatch.
And how do you play it?
You go long PEBO, but you pair it. You go short a basket of growth at all costs regional banks, the guys in the KRE ETF who are just recklessly crossing $10 billion without a plan.
So you're long discipline, short recklessness. I like it.
Exactly. But here's the kicker. You layer in out-of-the-money calls on PEBO dated for late 2026.
Why late 2026?
Because that's when the pressure cooker really starts to hiss. As they get closer to 2027, the pressure to do a deal intensifies. If they announce a transformational merger, the stock rips on the re-rate.
And if they don't, what's the downside?
If they don't, they keep shrinking the balance sheet, paying down debt, keeping the efficiency low, and paying you a dividend. The stock grinds up. It's a heads I win huge, tails I don't lose much trade.
That is spicy. It's betting on management's self-imposed claustrophobia.
And if you want to get really wild, big juice wild, you pair it with a short on subprime auto lenders.
To hedge the North Star leasing exposure.
Exactly. It's your insurance policy against the big juice turning sour.
I love it. The $9.9 billion pressure cooker ARB. Again, not financial advice, but definitely financial entertainment.
It's the kind of trade that gets you a promotion or fired. No middle ground.
So to wrap up, PEBO delivered a solid blocking and tackling kind of quarter. EPS beat, debt optimized, clear line in the sand on asset size.
They did. And I think the final thought is about choice. They are actively choosing boring and profitable over big and risky. In a market obsessed with hypergrowth, it's easy to overlook a bank in Marietta, Ohio that's just really good at math.
But in this market, boring might just be the new alpha.
I think you're right. When the tide goes out, you want the bank that built a seawall, not the one that was surfing.
Well said. Listeners, check your own models. Don't blindly follow the big juice. And keep an eye on that $10 billion threshold. It's going to be the story to watch.
Yep.
That is it for us on Talk Tickers. We will see you next time for another deep dive.
Good luck out there.